Hello again, everyone. This is Joe, and in this technical analysis of the stock market video, we're going to talk about a stock market setup that no one is talking about, so stay tuned. Okay, so what we see on the chart here is the Dow Jones Industrial Average weekly chart. And yes, we had a big move this week. Kicked off the first of the year, it was up almost 577 points. You can see the very tight compression that we had in the previous 2 weeks. So it's not surprising that after we get 2 weeks of very tight compression, we get a huge expansion type week. All the markets around the globe, China, Japan, Germany, the UK, and France, they were all up fairly well this week to start off the new year. But, this is not what I want to spend time talking about. I want to show you a chart back in history that kind of maps very closely to what we have here since 2000. So let's take a look at that chart. Okay, here's a chart from 1916, peak in 1916, all the way to the peak in 1929. Okay, this is equivalent to, I'll show you in a minute, the chart of for us, current in the 21st century in 2000. Okay, then we went down to like 2002. This dropped into the low in the late 2017. And then they thought they were going to a brand new glorious bull market, new high. They broke above that 1916 level and went to a peak here in 1919. That's the equivalent to what occurred for us in 2007. And then we collapsed in the Great Recession for us from 2007 into 2009. This went from 1919 into 1921, and it was a depression. Okay, it was called the Depression of 1920 to 1921. I just got a book, just came from Amazon today by James Grant. I'm looking forward to reading it, called The Forgotten Depression, the 1921, the crash that cured itself. So it's very, very fascinating to me. This period right here was 18 months. The period of 1920 to 21, the actual depression, was 18 months long. And the stock market dropped 46.6% in here. Okay, so just remember that 18 months of depression, stock market dropped 46.6%. It was one of the worst deflationary depressions. As a matter of fact, wholesale prices dropped the largest amount since the Revolutionary War. So it was very dramatic, very gut-wrenching. Unemployment hit 19%. Okay. Now, everybody talks about, it's kind of interesting because we had the Great Recession, 2007, 2009, and it was very gut-wrenching. It was really bad, and it was the worst since the Great Depression of the 30s. But everybody was immediately trying to compare it to the 30s. Okay. And I think what in reality we should be comparing it to is to what happened here in 20 to 21 in terms of the setup. Because what did this do? This whole move, this pattern, which is almost identical in terms of pattern from 2000 to 2009, this pattern set up the huge bull move of the 1920s. This is the peak 1929, okay? And so I find it really, really interesting, and it's kind of an eerie pattern that you kind of see this. This move from the lowest close in 1921 to the peak in 1929 was 6 times, the peak was 6 times the lowest close, okay? And it occurred in 8 years. This was the lowest close in here. This is a weekly chart, but the lowest daily close occurred on, it was August, I believe, of 1921. And then the peak occurred on September 3rd, almost the end of August, September 3rd of 1929, in terms of the actual daily price. And then, of course, what was followed after that was the huge crash and the Great Depression. And the actual Great Depression is considered to have lasted for 10 years. Even though the stock prices bottomed in 1932, the Great Depression is not considered to have ended until like 1939, something like that, as it went into the, unemployment was still very, very high as we entered World War II. All right, so let's scroll forward into the 21st century. Actually, before I do that, I want to point one thing out too. I want to point out this throwover that's occurring right in here. Okay, so we had this channel very similar to what we're doing right now since 2009, and a nice strong channel to channel upwards, but then all of a sudden towards the end we get a throwover over above that channel. So just remember that as we move forward into our current day. And let's look at that chart. Okay, so here we are with the 21st century and a similar type thing. Here's the equivalent of the 1916. Here was the bottom, and then here was the peak that happened in 2007. Just very similar to what happened between 1916 into 1921. Went to higher high and lower low, and this huge setup in Elliott wave terms. This is an expanded flat corrective activity, and then you flush out everything, and then it starts this tremendous rally. And notice the channeling that's going on, very similar to what happened in the 1920s. And then now we're getting this throwover above that channel, just like occurred towards the end of the run. Now we have gone a little bit longer, so what's some differences? We've gone almost 9 years. We're very close to 4 times the current price on the Dow of 25,295.87 is very close to 4 times the actual closing low price in March of 2009. So in the 20s, it was 6 times. Now we've gone 4 times. So could this continue to push a little bit higher? Yes. The fact that we're getting above this channel makes me very, very cautious about the whole setup and everything, but we haven't started to break down, at least not yet. Okay. So this is the pattern. This is the whole setup. And the other thing, as you start to look at, and I point this out, I have a post on my website where I go into a little more of the detail of this whole thing. But this whole move in here, right here, this is that period when the Great Recession occurred. It was 18 months long. The stock prices here lost 53.8% of the value on the Dow, okay, as compared to 46.6 from 1919 to 1921. Did we have deflation? No, we actually didn't, except if you owned a house and some of the people had, the houses on the coast, there was tremendous deflation in the housing prices. Okay, so if you look at the producer price index across the board, they might say, well, no, there wasn't really any deflation, blah, blah, blah. But if you looked at the housing index, somebody would argue, yes, there was. Okay, and this was very, very gut-wrenching, very dramatic. If you read Too Big to Fail, you'll get all the gory details about how the whole financial system almost came falling completely apart. So here we get this complete flush out at the end of 2008, 2009 into 2009, and we launch with all the money being printed in this huge rally, very similar to the way the whole depression of 1920 to 21 set up the huge rally into the roaring 20s. So I find it very fascinating. I wanted to pass that on to you. Is there any guarantee that, what's going to happen afterwards? No. But I just find the patterns. I'm always looking for patterns, always looking at prices, and I find it eerily similar. All right. I hope you found that helpful. If you did, please share the video, give it a thumbs up. And if you're not watching this on my website, which you probably aren't, head on over to the website and check out the post over there. All right, everyone, have a great week. We'll talk to you on the next video.